Gold is respected throughout the world for its value and rich history, which has been interwoven into cultures for thousands of years. Coins containing gold appeared around 800 BC, and the first pure gold coins were struck during the reign of King Croesus of Lydia about 300 years later. Throughout the centuries, people have continued to hold gold for various reasons. Societies, and now economies, have placed value on gold, thus perpetuating its worth. It is the metal we fall back on when other forms of currency don't work, which means it always has some value as insurance against tough times. Below are 8 practical reasons to think about owning some gold today. A history of holding its value. Unlike paper currency, coins or other assets, gold has maintained its value throughout the ages. People see gold as a way to pass on and preserve their wealth from one generation to the next. Since ancient times, people have valued the unique properties of the precious metal. Gold doesn't corrode and can be melted over a common flame, making it easy to work with and stamp as a coin. Moreover, gold has a unique and beautiful color, unlike other elements. The atoms in gold are heavier and the electrons move faster, creating absorption of some light, a process which took Einstein's theory of relativity to figure out. Weakness of the US dollar. Although the US dollar is one of the world's most important reserve currencies, when the value of the dollar falls against other currencies as it did between 1998 and 2008, this often prompts people to flock to the security of gold, which raises gold prices. The price of gold nearly tripled between 1998 and 2008, reaching the $1,000 an ounce milestone in early 2008 and nearly doubling between 2008 and 2012, hitting around the $1,800 to $1,900 mark. The decline in the US dollar occurred for a number of reasons, including the country's large budget and trade deficits and a large increase in the money supply. Inflation hedge. Gold has historically been an excellent hedge against inflation, because its price tends to rise when the cost of living increases. Over the past 50 years, investors have seen gold prices soar and the stock market plunge during high inflation years. This is because when fiat currency loses its purchasing power to inflation, gold tends to be priced in those currency units and thus tends to arise along with everything else. Moreover, gold is seen as a good store of value, so people may be encouraged to buy gold when they believe that their local currency is losing value. Deflation protection. Deflation is defined as a period in which prices decrease, when business activity slows and the economy is burdened by excessive debt, which has not been seen globally since the Great Depression of the 1930s, although a small degree of deflation occurred following the 2008 financial crisis in some parts of the world. During the Depression, the relative purchasing power of gold soared while other prices dropped sharply. This is because people chose to hoard cash, and the safest place to hold cash was in gold and gold coin at the time. Geopolitical uncertainty. Gold retains its value not only in times of financial uncertainty, but in times of geopolitical uncertainty. It is often called the crisis commodity, because people flee to its relative safety when world tensions rise. During such times, it often outperforms other investments. For example, gold prices experienced some major price movements this year in response to the crisis occurring in the European Union. Its price often rises the most when confidence in governments is low. Supply constraints. Much of the supply of gold in the market since the 1990s has come from sales of gold bullion from the vaults of global central banks. This selling by global central banks slowed greatly in 2008. At the same time, production of new gold from mines had been declining since 2000. According to BullionVault.com, annual gold mining output fell from 2,573 metric tons in 2000 to 2,444 metric tons in 2007. However, according to GoldSheetLinks.com, gold saw a rebound in production with output hitting nearly 2,700 metric tons in 2011. It can take from 5 to 10 years to bring a new mine into production. As a general rule, reduction in the supply of gold increases gold prices. Increasing demand in previous years, increased wealth of emerging market economies boosted demand for gold. In many of these countries, Gold is intertwined into the culture. India is one of the largest gold-consuming nations in the world. It has many uses there, including jewelry. As such, the Indian wedding season in October is traditionally the time of the year that sees the highest global demand for gold, though it has taken a tumble in 2012. In China, where gold bars are a traditional form of saving, the demand for gold has been steadfast. Demand for gold has also grown among investors. Many are beginning to see commodities, particularly gold, as an investment class into which funds should be allocated. In fact, SPDR Gold Trust became one of the largest ETFs in the US, as well as one of the world's largest holders of gold bullion in 2008, only 4 years after its inception. Portfolio diversification. The key to diversification is finding investments that are not closely correlated to one another. Gold has historically had a negative correlation to stocks and other financial instruments. Recent history bears this out. The 1970s was great for gold, but terrible for stocks. The 1980s and 1990s were wonderful for stocks, but horrible for gold. 2008 saw stocks drop substantially as consumers migrated to gold. Properly diversified investors combine gold with stocks and bonds in a portfolio to reduce the overall volatility and risk. Since the beginning of recorded history, gold has been a universal symbol of wealth. Because of its beauty and scarcity, ancient civilizations coveted the precious metal as a manifestation of status and power. Ornaments, jewelry, and early forms of money were all crafted from gold. Over the intervening millennia, the fascination with gold has hardly diminished. While most monetary systems are no longer tied to a gold standard, the metal is still considered insurance against fiat currencies that rely on faith to sustain their relative values. Gold has maintained intrinsic value because, unlike in the case of currencies, there is a limited supply of it that cannot be artificially increased. The allure of gold has made it a desirable alternative for those seeking diversification and the spreading of their risk. There are many ways to buy gold, both for decoration and as an investment. To many, it's also a hedge against economic upheaval, war, inflation, and global uncertainty. Gold as an investment. Before buying gold, it's important to understand some of the factors that make gold unique. Newly minted coins are typically 90% to 99% gold. Jewelry is typically 14 karat, 58%, in the United States or 18 karat, 75%, internationally, but other carat values can be found, all the way up to pure 24 karat, 100%. 1 Gold provides no income stream unless you own stocks or mutual funds that pay dividends. Owning gold stocks does not entitle you to possession of the metal. You may incur a cost to store physical gold. While the current supply is limited, as the price rises it makes more mining economically feasible, which could increase the supply. Demand is not a function of the true need for the metal, since much of it is not used for any commercial purpose other than the making of jewelry. Gold holdings are heavily concentrated among a limited number of governments and central banks, exposing gold to extreme price fluctuations as these institutions buy and sell. Coins. Uncirculated gold coins are currently being minted by several countries. While they are all legal tender, they have a meltdown value that far exceeds their face value. Many numismatic collectible coins have market values that are even higher. Collectors are attracted by the potential for rising values, based on the rarity and demand of the coins they buy. Newly minted coins are easy to buy, and their purity is guaranteed by the government mints that produce them. Some popular choices are the American Eagle, Canadian Maple Leaf, South African Krugerrand, Vienna Philharmonic, Mexican Gold 50 pesos, British Sovereign, Australian Kangaroo, and US Mint 24K Gold Buffalo. Some of these coins are available in multiple sizes to accommodate both large and small investors. For example, the American Eagle is minted in weights ranging from 1/10 ounce up to 1 ounce. 2. Liberty coins minted prior to 1933 were the only coins produced at all 7 of the U.S. mints that were in operation at that time. The minting of these coins ceased that year, in response to gold hoarding during the Great Depression, President Franklin Roosevelt signed an executive order calling in gold held by Americans, exempting only coins of recognized numismatic value. Point 3. Many American investors prefer old coins because they fear another government confiscation of gold and assume that collectible coins may again be exempt. The $5 half eagle and $10 eagle are popular coins that are readily available from coin dealers. The $20 double eagle is probably the most recognizable and desirable of the early gold coins. One of the most striking is the St. Gaudens, commissioned by President Theodore Roosevelt, and designed by famed sculptor Augustus St. Gaudens. Point 4. Old coins minted by other countries, including Great Britain, South Africa, China, Spain, and Mexico, are also attractive collectibles. Bullion or bars. While many people think of bullion as the large bars held in Fort Knox, bullion actually refers to the stamped weight and fineness of gold. It can be in bar form, round like a coin, or of any other shape representing a tradable and practical size and form. The price of bullion typically includes the cost of the metal, plus the costs related to refining and shipping, as well as the dealer's premium. The bars are available in various weights, starting at 1 gram. Heavy bars are best suited for large investors because they can be efficiently stored in an insured facility that specializes in precious metals. You also save on the add-on costs when you buy the heavier bars. The disadvantage is that the large bars are more difficult and costly to sell, and may be difficult to use as part of a barter. Bars are produced by several government mints, as well as private companies, such as Johnson Matthey, Wall Street Mint, Sunshine Minting, Credit Suisse, Engelhard, and Produits Artistiques de Metal Precio (PAM). Gold stocks and exchange-traded funds, ETFs. The primary advantages of stocks and ETFs are that you don't have to store the metal, and there is potential for earning dividends. Besides individual mining stocks, there are also mutual funds available that invest partially, or exclusively, in mining companies. These can provide diversification into other precious metals, such as platinum, palladium, and silver. You can also purchase options on gold futures contracts at an established strike price. ETFs hold bullion on your behalf. The symbol for the Standard & Poor's Depository Receipts, SPDR Gold Trust or SPDR, is GLD.5. These trade intraday, like stocks, and benefit from relatively low expense ratios. There is also a brokerage commission applied to each trade, so they aren't good candidates for gradual accumulation. Gold stocks don't necessarily move in concert with bullion prices, because mining companies succeed or fail based on their individual operating performance. You don't have the security of physical possession of the metal if the companies you buy are unsuccessful. Jewelry allows the investor in gold to also experience the enjoyment of wearing it. Gold is often combined with other precious gems and metals to enhance the overall value and appearance of the jewelry. Pieces are often passed down to the next generation as family heirlooms, adding sentimental value beyond that of the piece itself. Jewelry is not the best option if it's strictly an investment, because the price will usually far exceed the meltdown value. This is due to the workmanship involved and the retail markup. Always determine the purity of the gold before buying jewelry, so that you don't pay for 18 carats when you are only getting a 14-carat piece. Jewelry is covered by most homeowner insurance policies, which is an advantage in the event that your jewelry is lost or stolen. Vending machines. More recently, on-demand gold vending machines have been popping up in certain countries. The Gold-to-go ATM machines, for instance, are available at the Burj Khalifa in Dubai, offering point-of-sale gold bars 1 gram, 5 gram, 10 gram, and 1 ounce South African Krugerrand 1/10 ounce, 1/4 ounce, and 1 ounce Australian Kangaroo 1/10 ounce and 1 ounce Canadian Maple Leaf 1/10 ounce. Point 6. If these machines prove profitable, they are likely to expand to other affluent countries. The bottom line: gold should be an important part of a diversified investment portfolio because its price increases in response to events that cause the value of paper investments, such as stocks and bonds, to decline. Although the price of gold can be volatile in the short term, it has always maintained its value over the long term. Through the years, it has served as a hedge against inflation and the erosion of major currencies, and thus as an investment well worth considering.